Is now the perfect time to buy a company like ASML. ASML at the time of making this video trades at $722.5. You can also buy it if you're in Europe, you can buy it in euros on the Amsterdam exchange. It has a market cap of $285.5 billion and currently a forward PE of 30.9 times, pays a small dividend with the dividend yield sitting at 0.79%. As you can see, in the past year or so, the stock did peak back here in July, and since then, well, it lost almost all of its gains. If we look at the current analyst expectations for fiscal 2024, we can see that sales expected to be down 5.5% and EPS dropping 10.8% for fiscal 2024. But then we see a reacceleration in growth in fiscal 25 and fiscal 2026. Although in fiscal 2025, the rebound that was expected will only happen in the second half of the year. That's the current expectation. So let's discuss ASML a little bit deeper in this video, talk a little bit about the market sentiment right now. If you enjoy this type of videos, hit all the buttons, like, subscribe, do all of that. We really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Right now, if you look at the US 10-year bond yield, that sits at 4.79%. Back in September, that was at 3.62%. So quite higher today. And this is also why a lot of stocks are taking a hit more recently, plus the fact that currently the market is anticipating that there will be no rate cuts happening in the next January meeting and might actually not have any cuts in 2025. Although I think that's a bit much. That's a bit much of an overreaction. But right now, yes, if you can get 4.79%, the risk-free rate sits so high, why risk it on stocks? Usually when the rate 10-year is lower, stocks become more attractive. When those rates are up, stocks become less attractive. Switching back to ASML, the current average analyst price target sits 20.39% higher than the price we're at today. If we look at the current expectations for next earnings report, which will happen January 29th, that's on a Wednesday, we can see that revenue is expected to be up 11.5%, EBITDA up close to 14%, that's quarter over quarter, EBIT up 17.2%, EPS on a GAAP basis up 17.16%, and EPS on a non-GAAP up 17.32%. Looking at some pricing metrics, forward PE, EV to EBITDA, price to sales, price to free cash flow, the first three are under the 5-year mean. The only one that's above it is price to free cash flow. That's also the only one that shows you last 12 months and not next 12 months. Price earnings to growth is back under 2, sits at 1.84. Now looking at free cash flow, we can see that for the last 12 months, free cash flow is much lower than what we've seen in previous years and also lower than what it's expected to be for the full year of 2024. Fiscal year 2024 free cash flow is actually expected to be up 21.9%, and in fiscal 2025 that's expected to be up 87.8%, followed by another 35.6% year-over-year growth in fiscal 2026. Now, what has happened in the more recent quarters? Well, we can see that back here in the December quarter, so basically, well, now that's going to be 1 year ago, net bookings basically peaked. Since then, it has been coming down, did not help the stock. We can also see that service and field option revenue and net system sales revenue, that did continue to increase, both of them together, with last quarter being a record quarter. All in all, the market does keep a close eye on net bookings, which again has not really been that stable. We've seen a huge increase from the June 2020 quarter, and that peaked basically in October 2022. Since then, it did come down. Then we had that one quarter 1 year ago where we've seen a huge increase, but it has not really been that stable. But again, would you rather buy the stock here or would you rather buy the stock down here? It's the same with margins, it's the same with earnings. You'd rather buy it not at the peak, but closer to the bottom, even after a rebound. Speaking of peaks and bottoms, we can see a couple of things here. First of all, gross profit margin have increased in the last 10 years. We started at 42.4%. We're now sitting around 51%. What has been, as we've seen previously, not that stable, and that's free cash flow and free cash flow margin. Free cash flow margin peaked here at 57.6%. We're now well closer to 11%. which is quite low considering where we were 10 years ago. And so I go back to my point, you rather buy companies around here rather than here where things are already extremely high and likely to peak. Now with ASML, of course, it's tremendous business, tremendous leadership. Yes, they operate in it, let's call it a monopoly, but the issues are, of course, that the fact that, well, 47% of last quarter's revenue came from China. 2 quarters ago, that was closer to 49%. But if we go back to a recent earnings call, or I believe an investor day, they said the following. They expect China sales to be around 20% of their total revenue next year, trending back towards their historical China percentage and in line with its share of the backlog. So yes, the company still expects to grow overall revenue next year, but China will go, the share of revenue coming from China will come down, and that will be compensated by other regions. Remember, I said that the outlook for 2025 is going to be more about a recovery in the second half of 2025. Well, they also talked about that right here. So as they discussed back in the investor day of 2022, they provided market scenarios for 2025 of between 30 to 40 billion euros with a gross margin of between 54 to 56%. Based on the recent market dynamics that Christophe just described, they now see 2025 revenue moving through the lower half of the range, so between 30 billion euros and 35 billion euros. To a large extent, this is driven by significant reduction in their expected low-NA shipment for 2025 to fewer than 50. With regards to gross margin, one of the key drivers of the expected improvement was low-NA, driven by both an increase in the number of systems as well as a move to the higher margin 3800E system. While the improvement in gross margin for the 3800E system has been achieved, the large reduction in EUV unit numbers for next year is significantly margin dilutive in comparison to earlier expectations. Also, the reduction of their China sales, which typically contain high percentage of immersion sales, is dilutive to their gross margin. Therefore, based on the current outlook of lower revenue and less favorable mix in comparison to the 2022 investor day, they now expect a gross margin of between 51 to 53% in 2025, which, as we've seen, is still fine. Looking a bit further into the future, in that investor day, they also showed us, well, the roadmap. So EUV product roadmap enabling affordable scaling. When we look towards 2029, 2030 and onwards, we can see that they are going to reach the 1 nanometer node and even lower than that, 0.7 and 0.5 by 2030. Of course, to reach those results, you will need newer machines. With regards to those newer machines, we've had some news about that. So, according to the report, each EUV machine currently costs approximately $181 million. The new generation high-NA EUV machines, which Intel and TSMC currently have, cost around $290 to $362 million per unit. But the Hyper-NA Extreme Ultraviolet or EUV machines that it plans to launch by 2030 could exceed $724 million. So basically twice the price of the previous generation. Of course, it remains to be seen if all of the players today, TSMC, Samsung and Intel, are willing to pay that price, especially since the high-NA EUV machine already cost more than the previous ones. Since they already made those investments, Intel and Samsung actually are reducing the investment. So who's to say that they are going to be willing to pay such a high price since, well, they are already making huge investments with the current products. And there are even reports saying that folks at TSMC are going to, well, try to optimize and maximize the use of the current machines before they go and order, well, the next generation ones. But in my opinion, eventually they will all buy the newer machines because it only takes one of those companies to buy these new machines, and then all the others will follow because they do not want to fall behind. So if we look now at the stock itself, we can see it trades at, well, $723.7, which is basically just above the 20 and the 50-day moving average, under the 200-day one, which trades at $792.4. And so to conclude, is now the right time to buy ASML? I think now is a much better time to buy ASML than 6 months ago. Of course, under $700 a couple of weeks ago was probably also a good time, but to be honest, I don't see this company not growing in the future. I don't see how this company does not become more and more important in the future. So yes, for investors that are looking for a new position in the semiconductor industry or looking to add to their existing position, I think, yeah, it could be a very good time to buy a company like ASML. What do you think? Let me know down in the comment section below. Like, subscribe, do all of that, and I'll see you all in the next one. Bye bye.